is Market Moves.
Hello and welcome to Market Moves. Today's worst performer on the 200 is BC Iron, which fell 8.75%. Today's star performer is Cenex Energy, which rose 8.5%. More on them later, but first let's take a look at how the share market performed. The S&P ASX 200 closed down 0.2% at 5,219 points. To the performance of the different sectors, the materials sector led the market lower, losing 1.4%. Utilities also weaker, down 0.5%. On the other side of the ledger, energy had the best gains, up 1.6%. 93 stocks rose today, while 97 fell and 10 held steady. And looking at the biggest drag on the market by index weight, BHP fell 6.9 index points. CBA also weaker, down 2.9 index points. Rio Tinto, Westpac and ANZ rounding out the bottom movers by index weight. And the biggest movers in terms of index weight, Westfield led up the market higher, up 2.2 index points. Origin Energy also stronger with a rise of 1.5 index points. AMP, Woodside and Central Group also making the list today. And here to take us through what's moving markets and why, Michael Kodari from KOSEC. And you too can join in the conversation with a question or comment by emailing us at yourmoney@skynews.com.au or by using the hashtag MarketMoves on Twitter. An unexpected executive shake-up for Qantas, with the airline announcing a new leadership team after the close today. Qantas International CEO Simon Hickey and domestic CEO Lyle Stramby are exiting the group just days after the airline gave an upbeat earnings update, while Group CEO Alan Joyce will remain in the top job. Qantas Airways Chief Operating Officer Andrew David will step into Mr Stramby's role, and his current position will not be replaced. Several other roles are also being scrapped, including Deputy CFO and Qantas-linked Chief Executive. Current Group CFO Gareth Evans will become CEO of Qantas International and Freight. The transition to the new structure will begin in the new year. Well, Michael, what do you think about the shake-up in Qantas management? What sort of does this indicate for the company?
Look, I guess a shake-up. A company's made out of its people, and people are assets. So better management, better people will hopefully do good for the company long term. So Qantas has had its ups and downs. They're taking advantage of lower oil prices. A lot of transport, logistic companies are, and Qantas is up there. So from a lot of the airlines out there, they're one of the best. But then it's very hard when you don't get any backing from the government, whereas a lot of international airlines, they're backed off by their government. So I guess they've got to be run very smart, and management's key. So you need great management in any business to take you to the next level, and that's what Qantas is trying to do.
And what do you think about investing in airlines shares?
Look, it's very tough, it's very hard to make money in an airline. Like Richard Branson says, if you want to be a millionaire, start off as a billionaire and invest in the airline industry. So it's very, very tough, and you've got to be careful. So, you've got disasters overseas, you've got terrorism attacks, you've got oil prices, God forbid if there's a crash. So it has a big effect, and you've seen what happened in Malaysian Airlines. Hopefully, thank God that hasn't happened with Qantas. So, Qantas has had it good, and all the prices are towards its favour. So I think, it's a good company. It's taking advantage of lower oil prices, but you've got to be very careful. Airlines are always very tough businesses.
Now, the market wallowed to its third straight day of losses. What's been going wrong?
Look, we've got 11 trading days left. The market's down 2.5% for the year. We've got the lower Aussie dollar. So Glenn Stevens coming out and saying, it's expecting it to reach 75 cents. We've got oil prices down, iron ore prices down, consumer confidence is down. So it's very interesting. If you're investing in the market, it's very tough, because almost half of our market's in oil, gas and mining. So, it tells you've got to be very selective in terms of what sectors you put your money in. So for us, it's been healthcare, telco and some online retail. So those are the sectors and businesses we're investing in, and they're outperforming the market. A lot of these companies are up 50, 60% for the year, while the market's down 2.5%.
And how has that latest unemployment data impacted on the market, if it has?
Yeah, well, 5.7% lower, the lowest in the highest in 6 years. 6.3% unemployment rate is very high. Adds a lot of uncertainty. I think next year is going to be very tough. And consumer confidence is low too. So what happens if consumer confidence is low? People tend to spend less, they save more. It's not good for the economy. So, you know, the government has to create more jobs. Interest rates have a big part in this. So if it's at 2.5% and things aren't going very well, maybe we need an interest rate cut. You know, it all goes back to the consumer and business confidence.
So what sort of stocks should investors be focusing on for the new year?
Look, it's a no-brainer. With the Australian dollar going down, you've got to be in companies that are taking advantage of the lower Aussie dollar. So companies that are earning in US dollars. The US economy is doing very well. Again, consumer confidence was at the highest in 8 months because of lower oil prices and the fact that jobless figures are much better. So, you know, companies that are reporting in the US dollar will take advantage. And these are a lot of these healthcare businesses like, you know, you got Cochlea, CSL, Certex, ResMed, Ramsay Healthcare. So it's about picking these good businesses in the healthcare sector to invest in. And we've got a lot of the telco sector. We've got companies like TPG Telecom. You know, it's been one that we've recommended every month for the past 2 years. And it's up 400% in the past 2 years. So, you know, you've got to be very selective. It's a stock picker market. So investing in an entire market, you're taking a lot of risk. You've got to be very careful the sectors you choose.
But these stocks do have quite a high entry point, do they, expense-wise?
Look, price to earnings are very high, but then again, you know, PE isn't the all and end all, right? If the PE of a company is, you know, 40, 50, it's because the market's expecting its earnings to be high. So, you know, for us, if a business continues to do well and the track history is there, we tend to put our money in it because usually it tends to follow. And management is one of the key things. So you've had Qantas change management teams, and for us, it's about those businesses that have great management and a large stake in the business themselves. Like TPG's management has 40% stake in the company. So your interests are aligned with management and the shareholders.
Okay. Well, let's take a look at some of the day's highs and lows. The market hit a high of 5,241 and a low of 5,204. Around 641 million stocks changed hands, worth around $3.8 billion. And in terms of stocks by volume traded, Lynas was the most traded stock today with 33.6 million shares changing hands. Arium also heavily traded with 33.5 million shares exchanged. Paladin Energy rounding out the top 3 stocks by volumes traded. So, I mean, what can we say about the fact that Lynas was the most heavily traded stock today?
Well, Carolyn, Lynas has been a very interesting one. So they've had a very good story. A lot of Lynas investors are like a cult. They really follow the stock. So, you know, they were hoping this stock to hit $10. It was trading at $2, $3. It's now down towards, you know, around the 46-50 cents mark. And it's because, you know, you can't invest in the stock market on the back of a good story. If a company hasn't made any money, if they've got problems, you know, Lynas has had a lot of problems, political problems within the Chinese and the Malaysian government. So you've got to be very careful. It's had a good story, but unfortunately it hasn't returned anything. And it's one of those volatile stocks. It's something we've stayed away from. So for the past 2 years. And, you know, again, the share price, you know, keeps dropping and it's volatile. So you're taking a lot of risk being a company like Lynas, whereas there's opportunities elsewhere.
OK, well, let's take a look at some of the bottom movers of the day, starting with the All Ords. And now to the bottom performers on percentage change on the ASX 200 today. BC Iron had a shocker on the market, down 8.8%, shares closing at 36.5 cents. The second worst performer was Drill Search, down 6.7%, shares finishing at 69.5 cents. And rounding out the bottom 3, Lynas lost 6.3%, shares closed at 4.5 cents. Rounding out the bottom 8 performers today was Resolute Mining, Sirius Resources, 10 Network, Medusa Mining and Independence Group. So a terrible day today for BC Iron. They're down 8.75%. I mean, we probably sound like a broken record here, but obviously it's the iron ore price.
Yeah, iron ore. Look, you want to be in businesses that are price takers. You know, these businesses are price takers. So if iron ore comes down to $70, you know, they can't control it. So you've got to. It's a very capital-intensive industry. It's not just identifying iron ore. It's about the cost of actually digging this stuff out. And, you know, you've got to stick with the big players like your Rio Tintos or your BHPs. These businesses, even though some of them that are quite large, they're going to suffer because the margin's very low. So businesses that are price takers, stay way away from it. You know, we haven't placed a single trade in the past 2 years in any miner or iron ore stock because they're price takers. And China's GDP has been slowing down, and that was a no-brainer for us. So that's going to have a big effect upon the world globally, and the fact that half of our stocks are in the resource mining sector. So you've got to take the macroeconomics into account when you're actually picking a stock. And if you're emotionally attached to a company like BC Iron, you've got to be very careful. Sometimes it's better to cut your losses and move your money around somewhere else where you know, the prospects look much brighter.
So for investors that hold the likes of Arium or BC Iron or Atlas Iron, which has lost something like 95% of its value this year, should they be cutting and running now? Look,
China's gone through a different transition. They've gone from, they're moving more towards a services industry, so that's going to have an effect upon demand. Now, 20 years ago, a lot of infrastructure has been put in place in iron ore. Now supply is very high. So it's all a supply and demand game. If supplies are very high, demand's less, you know, iron ore prices are going to take a big hit, and that's what you're seeing. And a lot of these businesses, even though they might be very good businesses, they can't control the iron ore price. So it's something that, you know, I would say you could possibly cut your losses and move away to maybe the healthcare sector.
Now, Drill Search has also had a terrible day, down 7%. What can you say about that mining services sector?
Look, it's interesting. You know, before you could, if there was a gold rush and if you sell shovels, you could still make money. But now that's even tough because not a lot of people are rushing out there to get gold. So, you know, you're stuck in a situation where a lot of great mining services companies, a lot of these businesses that actually assisted these companies are also suffering because the demand isn't there. So you can have a very good mining services business, but if the demand's against you, then you can't make money, and that's the problem we're seeing with a lot of these companies.
And Resolute is also down 6%, obviously a gold producer. Well, why, considering the gold price has been up the last couple of days, why have they dropped?
Look, again, you know, you can buy into gold itself and you can do very well, but you're buying into a business. The business is run by people, you know, it's got to have no issues, it's got to produce gold at a rate that's quite attractive. Now, we invested in a company called Regis Resources about 3 years ago, which had a return on equity of 27%, no debt. It produced gold at $503 an ounce when gold was trading at $1,700. It did very well. Resolute Mining has had its issues, and you know, you've got to be very careful. They need a lot of cash flow, and you know, management's key to running these businesses, especially in tough times like this. Gold price has gone up, but again, when you look at it, you know, gold isn't doing much. Interest rates being very low, it stimulates more growth towards the share market and property. But you know, gold has always been a safe haven. But you know, if you're in a situation where gold isn't doing much, the share market is very volatile, so where should you put your money? You've got to pick good businesses. That's the best way to invest.
And what sort of businesses in gold would you recommend?
Look, at this stage, I'll be staying away from gold. You know, I don't think with lower interest rates, I'll be buying any gold stocks. But businesses that have a lot of cash flow, you need a lot of cash flow. It's a capital-intensive industry, and businesses that have things in place, they're actually producing gold. I wouldn't look at any explorer out there. Now is probably the worst time to look at explorer. So, you know, I think it's about sticking with those businesses that have a good track history, a lot of cash flow. They're producing gold at a very cheap rate, and you know, they've got a lot of assets. They've got good tenements.
Some wise words there. Well, after this short break, we'll have a look at the top movers of the day. Welcome back. Let's check the top performers by percentage change on the ASX 200 today. The best performer on the market was CNBC Energy. It rose 8.5% today, finishing at 25.5 cents. The second best performer was Sandfire. It rose 4.7% today, finishing at $4.21. And rounding out the top three, Whitehaven Coal rose 4.1%, shares ending at $1.15. Rounding out the top 8 performers today was Westfield, Origin Energy, carsales.com, Arium and Santos. Okay, so Senex Energy has had a really good day, up 8.5%. Why is this, given that they're in the energy space?
Look, it's just sometimes, stocks can be oversold. And but then again, I'll be very wary of any company in the energy space. I said it last week, and again, it's you're swimming against the wave. So it doesn't matter how good of a swimmer you are, you'll still get caught and wash ashore. So again, it could be just a dead cat bounce. But it'll be something I'll be very wary of. So
investors really shouldn't read too much into that figure then?
Energy, it's very hard. First of all, it's very hard to pick good businesses in the energy sector, and especially with what's happening with oil prices. And the OPEC, the 3 largest members having a meeting and supplying oil at the cheapest rate they've done over a decade to Asia. I mean, that itself is very concerning for a lot of businesses. So, I see a lot. You got to be very wary in that sector, and it's something we're staying way away from.
Yeah, another one. I don't know whether you should say investors should stay away from it. Whitehaven Coal. Now, so many brokers I've spoken to have said there is no future in coal. Yeah. Do you tend to agree with that?
Look, Whitehaven's been my sell throughout the year, so it's had a lot of problems. They started paying a lot of dividend yield to attract a lot of investors, so they were paying about 12%. Coal industry, again, the price takers, it's very hard. They've had their management issues. They've sort of picked up over the past couple of months, but then they're back down again. So it will be something that I'll be very wary of investing in. So coal, whether it's oil, gas, gold, copper, it's something that, the sentiment towards it isn't very positive. And in terms of macroeconomics, a lot of developing nations or the fast-moving nations like China, they've been consuming a lot of these over the past 10, 20 years. But now their demand is slowing and the reserves are getting very high, and a lot of companies are producing a lot more. So that's the problem we're having.
And Westfield's another one that's interesting. That's up 3% today. And why would that be, given consumer sentiment is down and the retail space is struggling to some extent?
Look, it's an interesting one. Westfield, the whole model of Westfield, they do charge a lot of rent for a lot of retailers, and a lot of them in those shopping centres are your major big ones. They can actually afford it and put it as a marketing loss. So, the whole model of Westfield, I think, it's an industry that's very tough. Will have a lot of problems moving forward as you've got online retail, and it's very hard for these businesses to make margins when rents are so high. So then again, it's a stock that's had its tough times, and it's had a 3% bounce, but it's something I'll be very wary of investing in. So retail is very tough. If consumer confidence is low, and it's the lowest it's been in, I think 3 years, and, it's very tough for businesses to sustain themselves when people aren't spending any money. So I think this Christmas will be a very tough Christmas out there for a lot of people.
Okay. Now let's look at the day's upgrades and downgrades thanks to FN Arena. Morgan's downgrades ERM Power to a hold, cutting the price target by 36 cents to $2.18. ERM has acquired Texas-based electricity retailer Source Power and Gas for US $7.8 million, highlighting the company's decision to enter the US electricity retail market. The broker thinks the transaction positively, but forecasting growth will be difficult. Following the run in the share price, the broker downgrades the stock but thinks the 12.5-cent dividend is a good reason to hold. Citi reiterates a buy on Santos, raising the price target by 12 cents to $15.17. Santos has reduced 2015 capex by 25% to better position its balance sheet. Citi views this as more of a deferral and expects the funds will be reinstated if the oil price rises. The company has reiterated it does not intend to raise equity. Citi values Santos using a long-term Brent price of US $90. The broker believes the market has overcalled the lower pricing of oil and also the need for Santos to raise equity. And UBS upgrades the reject shop to a neutral, cutting the price target by $1.30 and $6.60. A number of retail consumer companies have provided weak trading updates at their recent AGMs. The broker notes, and it's now crunch time for the reject shop. The broker estimates 99% of TRS's profit is generated in the December half, and most of that in the last 6 weeks of the year. The broker thinks the stock offers a positive shareholder return at the current price at which it sells. Okay, so Michael, Air Power has been downgraded to a hold. So why is this?
Look, it's, I mean, a lot of these large institutions come out with their ratings. I mean, look, for us, it's about seeing the valuation of the stock by looking at their assets, liabilities, cash flow, return on equity, their debt levels, and their business models and structures. So, you know, it's a business that we saw as being overvalued for a long time. It's not something we're investing in, and, you know, for me, it's a no-brainer why it's a hold. So, I mean, there's over 2,000 companies out there. There's many more you can choose from than a company like this.
And what do you think about the reject shop? It's been upgraded to neutral. I mean, another in the retail space.
Yeah, look, reject shop started expanding a lot. It's had a fair bit of difficulties. Sometimes they, you know, when businesses overexpand, it's very hard to control and keep their return on equity very high. So at one stage, their return on equity was 70%. So if you gave this business $1, it will give you back $1.70 each year. So very good business. But it's had a lot of difficulties in terms of management, and they've been expanding a fair bit. And sometimes, you know, an aggressive expansion, there's a lot of risks involved. And, you know, I just think at this stage, it's not a very attractive business. And the share price has sort of followed the performance of the business over the past couple of years.
So who are its main competitors then, the reject shop?
Look, the great thing about the reject shop was they had the $2-3 store model, but it was much more organised. And I remember, you know, 6-7 years ago, we were investing in this company at $3, and it went up all the way to about $15, and we did quite well. But, you know, sometimes when you expand too big, you're having problems in your store. They were having a lot of problems in Brisbane and Queensland, where the stores had a fair bit of flooding from storms, which had a big effect 2 years ago. I just think that, you know, the model itself, they're competing with the sort of the lower end. So if there's a GFC, you know, people still buy toothpaste, you know, your everyday goods. And so they're in a good space for that sort of environment. But, you know, interest rates are so low. You know, I still think, you know, luxury items at this stage are a way to go for a lot of these businesses.
All right. Thank you, Michael. We're going to have to leave it there. That's all we have time for in this edition of Market Moves. A big thank you to our guest host, Michael Kodari from KOSEC. I'm Carolyn Herbert from the team here. Thanks for your company.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.